Today, for the Series 65 exam, we're tackling the critical differences between exchange-traded funds, or ETFs, and mutual funds. The exam will test your understanding of three core distinctions: intraday trading, tax efficiency, and the creation and redemption mechanism. Let's start with intraday trading. ETFs trade on stock exchanges throughout the day, just like individual stocks. This means an investment advisor representative can buy or sell an ETF for a client at 10 a.m., 1 p.m., or any time the market is open, at a price that is fluctuating second by second. A mutual fund, however, only prices once per day after the market closes. All buy and sell orders placed during the day will receive the same net asset value, or NAV, calculated at the end of that day. The exam might present a scenario where a client wants to react to breaking market news. In this case, the ETF's intraday liquidity makes it the more suitable vehicle. A common trap is a question that implies you can get a specific price for a mutual fund during the trading day. You cannot, due to this once-daily, forward pricing mechanism. Now, let's discuss tax efficiency, a heavily tested concept. ETFs are generally more tax efficient than mutual funds. This advantage stems from the creation and redemption process. When a mutual fund investor wants to sell their shares, the fund manager often has to sell underlying securities to raise cash to pay the redeeming shareholder. This selling can trigger capital gains, which are then distributed to all remaining shareholders in the fund, creating a taxable event even for those who didn't sell. ETFs avoid this issue through what's called an in-kind creation and redemption process. Large, institutional investors, known as authorized participants, or APs, handle the large-scale buying and selling. To redeem shares, an AP exchanges a large block of ETF shares with the ETF issuer, not for cash, but for the actual underlying stocks and bonds. Because the fund itself isn't selling securities for cash, it doesn't generate as many taxable capital gains. For a client in a high tax bracket holding investments in a taxable account, an ETF is often the more suitable recommendation due to this structural tax advantage. The exam will also expect you to distinguish between index ETFs and active ETFs. Most ETFs are passively managed, meaning they aim to track a specific market index, like the S&P 500. This passive nature typically results in lower expense ratios compared to actively managed funds. Active ETFs, on the other hand, have a portfolio manager making decisions to try and outperform an index. While still generally more tax efficient and lower cost than their active mutual fund counterparts, active ETFs will have higher turnover and expense ratios than index ETFs. A key exam point is that for general questions about ETFs, you should assume they are the passive index tracking variety, unless the question specifies otherwise. When is each more appropriate? For a client seeking broad market exposure at the lowest possible cost and highest tax efficiency, an index ETF is a strong choice. If a client believes in a manager's ability to outperform the market and is willing to accept higher fees, an active fund might be considered, with an active ETF often being a more tax-efficient choice than an active mutual fund. Here's a phrase to remember: the key trading difference. ETFs trade all day, but mutual funds wait for the final say. This highlights the intraday trading of ETFs versus the end-of-day pricing of mutual funds. Be wary of exam questions that present a high net worth client with a large portfolio in a taxable account who is concerned about taxes. The answer will almost certainly lean towards an ETF over a comparable mutual fund because of the tax efficiency gained from the in-kind redemption process. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.